Welcome to Chapter 13. This chapter discusses the traditional techniques used for evaluating mining projects, including short-form techniques used by operating mines and techniques for formulating mining strategies in a corporate-wide sense. The traditional methods of decision-making in evaluating the feasibility of a particular mine project include a feasibility study, a discounted cash flow analysis, and a sensitivity analysis. Yet, even going through a detailed analysis won't result in much of a difference in the return on investment calculation than a broad brush study. However, for mining companies and those providing financing, they want these detailed studies, even though the return on investment numbers don't vary much from the broad brush approach. For any given ore body, the return on investment is often less dependent on any particular mine plan than on factors that are independent of the plan. The geological and metallurgical characteristics are largely independent of the mine plan. The selling price, exchange rate, and distance to market are largely independent of the mine plan. Misguided detailed planning can, of course, reduce the ROI quite easily. This aside, detailed analysis as traditionally practiced is aimed at refining the estimates within a well-defined set of constraints. Unless these constraints are re-examined or additional ore is found, the competitive position of most projects changes little through the evaluation process. If the ROI does not change much with refined planning, then two conclusions seem to follow. Number one, early stage evaluations are probably quite reliable indicators of the fundamental economics. If these early stage evaluations do not demonstrate a satisfactory return, then technical priorities should probably be focused on continuing to look for other projects that do. This is the entrepreneurial or exploration-focused approach. Number two, for projects that do meet the investment criteria, there appears to be little value in any more detailed assessment when the expected return on investment will probably change very little. The first of these conclusions is valid. The discovery of high-grade ore bodies and completely new processes has been an important road to success for many companies. The second conclusion bears re-examination. Major mining companies do not commit to important new developments without a detailed study. Finance houses insist on detailed studies before they agree to debt funding. These organizations would not demand this work unless they were convinced of the value of it. Personnel involved in production have little time for refined analysis. Refined analysis takes time, and the additional cost and lost revenue during this time frequently accounts for more value potentially lost than potential gains. This section examines some of the trade-offs and some of the common short-form techniques in operating mine environments. First is the strip ratio. There is a strong correlation between the whole mine economics and the amount of waste that has been moved for each ton of coal. How reliable of an indicator is this? The strip ratio suggests mine costs are a function of the amount of waste, mine revenues are a function of amount of ore or coal. A low ratio means low costs in relation to revenue and therefore is an indicator of relative profit. Low strip ratio mines have a significant proportion of their cost associated with mining of the ore or coal. In this case, the ratio, waste plus ore divided by ore, is better than the strip ratio as an indicator of relative economic value in an operating mine. For the strip ratio to be a faithful indicator, a volume of waste or ore in one part of the mine has to have similar cost as the same volume of waste or ore elsewhere in the mine. Large open pit mines frequently remove all material in the pit using similar equipment, and the cost of mining is primarily a function of depth. The operators adjust the strip ratio calculation for changing haulage cost with depth. Even if the strip ratio faithfully represents the relative cost over revenue, what are the costs? Total costs or only operating costs? For short-term guidance, operating costs are the more faithful indicator of costs. For medium or longer-term guidance, total costs are more appropriate. Differences in capital intensiveness can lead to differences in results. I don't like copying whole sections of text, but this is important, so I wanted you to see it as I narrate. Many major resource projects begin with large initial investments in relatively unproductive capital. Fixed capital expenditure largely independent of production. These expenditures include administration facilities, towns, roads, railway lines, ports, and other infrastructure. The return on this investment must be covered by the initially planned mine output, but the return from incremental output has to cover only the incremental investment. In these circumstances, any expansion that yields increased production is usually quite profitable. In this environment, a culture has developed that suggests mine economics can always be improved by increased production. If mine economics can be improved through expansion, then why wasn't the mine started at a higher production rate in the first place? There are two strong reasons for expansion that are quite valid. The first, the ore body may have been poorly understood at the time of the original mine development, yet was still economical. With extra understanding and extra reserves, mine expansion is rational. The second, the markets for mining products are often quite inelastic or unchanging in the short term. Customers have large investments in unique capital, and increased offtake from new mining developments requires restructuring of the capital in these downstream processes, a time-consuming task. Operating mines are judged primarily on their ability to meet production targets. Only a very few people on the mine site are concerned with cost per ton, and even then the criterion is commonly operating cost per ton. Operating costs may include depreciation provisions, but otherwise they overlook efficiency in the usage of capital. Every mine is most sensitive to loss of revenue. For any given selling price, usually outside the mine operator's control anyway, loss of revenue equates exactly with a loss of production. The problem with this singular focus is that anything that is likely to avoid interruption of production and hence disruption to the revenue stream is likely to be deemed justifiable. Excuse me. $1 of prevention, advanced planning, might achieve the same result as $1 million of remedial measures. And a singular focus of production does not provide sufficient incentives to balance the cost effectiveness of prevention with the cost effectiveness of remediation. Unfortunately, this doesn't apply to mining. Many businesses, it doesn't only apply to mining, many businesses won't spend the money up front to anticipate, to do the advanced planning that might minimize the need for remedial action. Those of you involved in maintenance activities understand this. If you do proper preventive maintenance on equipment, then the likelihood of a major breakdown is minimized. But to do that, you take the equipment out of production. Narrow-thinking people would rather risk a major breakdown than lose production. The title of this textbook is Mining Economics and Strategy. If all decisions were based on numbers, then we would only be talking about economics and formulas for figuring out our costs. The reality is that every mining company has core unique competencies that separate it from their competition. So for a mine, the ore body is unique. For Coca-Cola, their formula is unique. For KFC, their chicken recipe is unique. But even Coke and KFC don't sit on one unique input over time. The ability to discover new inputs and enhance existing ones is important to long-term success. In mining, this ability is a characteristic of an exploration-focused company, not a mining company. If an enterprise is to sustain itself over the long term, then unique inputs are itself required. But they must be inputs that are a feature of the organization itself. These inputs cannot be sold except by selling the organization itself. So think back to last week's exercise dealing with Ramaco's new mine investment. Do you think they saw some unique core competency there that helped them make a decision to buy that went beyond the pure economic numbers? Mechanisms for updating, expanding, and extending knowledge can be referred to as organizational learning. If an organization produces the same item year in and year out, and if the culture of the organization encourages it, then better and better ways will be found to produce the item in a faster or cheaper manner. Even if another organization were to purchase the identical plant and machines, there's no guarantee that they could replicate the institutional knowledge that provides the efficiency to the incumbent. The theory discussed in the text is that through organization learning, the more experience an organization obtains, total production, the more number of inputs, direct man hours, continues to decrease. To carry it further, assuming a competitive market where everyone sells at the same price, the most profitable company will be the one with the lowest overall cost of production. Then, if there are no further unique inputs and all organizations have the same capacity to learn from experience, then the lowest cost producer will be the one with the most experience. Thus, market share becomes an important strategic aim. Organizations with high market share advance along with experience line faster than organizations with low market share. Chapter 14 looks at discount rates and the relationship between risk and return, and it develops conceptual tools for making comparisons. The valuation of capital assets is a function of the expected future earnings, including the probability that they will materialize, discounted at a rate that reflects the time and risk preferences of the participants. Low discount rates reflect more confidence in the future and increase the future value of all projects. Mining industry investment traditionally demands a higher return because of the higher perceived risk. Concerning the sustainability of long-term return, the threshold expected return on investment for a particular project should be greater than or equal to the cost of capital for that project, plus premiums for the cost of exploring for and evaluating new projects to ultimately replace the economic reserves being depleted by this project, the cost of maintaining the company knowledge base and other intangible company assets to actually deliver operational capability on this and any future replacement projects. And finally, additional risk associated with the project until it starts performing with sufficient consistency so that it can be assessed by the marketplace. The average return from mining company portfolio investments has not been any greater than any other grouped investments in the stock market. This is to be expected. The performance of a mining company will be reduced by the expenses of absorbing ongoing exploration, absorbing and assimilating technology for the next phases of development without being able to fully capitalize on the just learned technologies, and absorbing the losses from projects that yield lower than expected return, insofar as they were not counterbalanced by the projects that yielded the higher than expected return. For major resource projects, these sequential steps should be used listed in priority order. For decision making for making larger investments, first, all investment is relative to something, the do-nothing case usually. Second, establish the broad economics of the alternatives. Third, determine whether the project has an expected return exceeding the likely marginal cost of the capital. Fourth, invest in information for more evaluation. And fifth, for all projects satisfying this criterion, rank in order of the expected net present value. The text goes further and gives an example of whether to choose a new dragline or a refurbished dragline with a lower capital cost. Take some time to follow their thinking in this case. My interpretation of the exercise is that if the net present value of both options is close, I would prefer the new dragline as it will be more dependable, have less potential downtime, so the return on investment would be more consistent.